So my name is Catherine Kraemer. I'm with the State of Maryland Department of Housing with the Maryland Mortgage Program. And most of you I probably know, but if I don't, I've been with this state agency for about 14 years. I'm not new to the mortgage industry. I've been a processor, underwriter, closer. I was a loan officer for many, many years. I've never been a real estate agent, but I came and joined the state, and the position I'm in is it's a blessing truly, because I feel very well connected with the private sector. And I literally can say, you know, like, I've been a loan officer, I've been a processor, I've been an underwriter, I've closed loans because of the amount of years I've been in the market. I've never been a real estate agent, so hats off to you guys. I know it's very challenging because you know, obviously borrowers come to you and they have this envision of what they want, but then you have to remind them of what they can actually afford. And we want to make sure that not only are you using our top performing lenders like primary residential, but that you're also very well versed on the programs that we offer as well. The website that I'm using, I'm not going to read you a PowerPoint. I've been doing this for years. I think everyone knows how to read. I'm going to show you where the PowerPoint is on our website, and it's a great tool. But one thing that the pandemic has definitely afforded us an opportunity for me is to kind of get away from that old paper PowerPoint and literally take you into our website and show you how to navigate the website to find what you need. So with this page, it's the mmp.maryland, MARYLAND.gov. And when you're on the website, you'll notice that you'll see homepage, and all the way to the right-hand side, you're going to click on professional portal. You're going to scroll down and you're going to see this yellow box. Anybody, literally, like the lady at Royal Farms, could click on here. It's a public website. Your borrowers could click on here. And believe it or not, we were just talking a few minutes ago about the market and how a lot of our borrowers are very, very savvy. So borrowers come on to our website constantly to utilize the programs as well, or to empower themselves with knowledge. We also worked really hard over the last 2 years of the pandemic because we were trying to rebrand ourselves to make it more accessible for people with the way that the industry was performing. And we want to make sure that our agents are aware of how to use the website as well. It truly is the tool for the lenders, but we value all the partners. So this yellow box, sign up for it. Anybody can sign up. You'll get, when you sign up for it, you're putting your name, who you are, what company or agency you represent, and you're putting your email address in. That email address is going to link you to receive these rate sheets that are generated on a daily basis. Also directives and notifications. It's more for a lender, but anybody can get them. We've only sent out 3 of them this whole year, but they're very informative. It'll let you know if we've ended a particular program, then you'll see it on the rate sheet. It's not there anymore. Or if we started new programs, which we just recently did, to again make it easy for you to utilize the programs in this very volatile market. So we send out directives and notifications to let you know if we've made any changes, and you'll see them on the website. Partner news, not only do I do trainings for real estate agents and teach CE classes, as well as all the board and associations, but I deal also directly with the lenders. That's my primary goal. Focus, yes.
Quick question. So if we sign up for that, the email subscription, is there any copyright protection or anything like that that prevents us from sending it to clients, or are we free to send it to whoever?
No, you can send it to whoever. Yep. Because it's public knowledge. And again, the partner news, we want to also show that we value the relationship that we have with the partners. So we will send out information that maybe some of our lenders have shared with us. We'll send out information about any upcoming events that are open to the public. We'll send out, my primary focus is really doing training for lenders to make sure that they know how to originate, process, underwrite, close. Because at the end of the day, we can all be out here selling away, but if it doesn't close, it doesn't mean anything, right? So we want to make sure that the loan gets in, a one and done, get it done, right? So the partner news, we also started doing trainings once a month for anybody just to kind of jump on. It's it'll be shown in the partner. I think the one I'm doing is for sales. It's going to be on June 21st, I think. And then we have one on June 23rd. I think it's for closing and post-closing.
Are those events on the website?
Yep. So when you pass this yellow box, you'll see a man with a pair of glasses, and you're gonna wanna click on his picture. And this is the window to our brain. And it's kind of scary because, like, I know I am a state agency, so it's a government, a website, but this is where all the bullets are. This is where you're gonna find everything that you need to find out. We make sure that we update everything on here. So if we change a rate on a program, you're gonna see it on the rate sheet. It's generated every day at 10 o'clock. You sign up for it, you'll get it. We make sure that if we've made any adjustments to our household income limits, I'll show you in a second the income limit chart. It'll show you that the income limits have changed, which is usually in a positive swing to allow you to bring a little more money into the door to help you afford that prices of homes now, because obviously everything's starting to go up. So if things are going up, we gotta let you allow to have more income, right?
Baltimore County needs to go back up.
Yes, it does. Even Howard County.
I know.
So this is where we have all the, I guess, again, the window to our brain. I did share with everyone, but I don't know if you were able to send it out, the 6 eligibility guidelines, okay? So I shared with Melissa a sheet called 6 eligibility guidelines and then the product matrix. But I will tell you, as standing in here with Primary Residential, they are one of our top performing lenders. They could do this with their eyes closed. So you're really going to be relying on the lender to make sure that your borrower meets the eligibility guidelines. I'm just basically going to briefly go over them with you. But so here we go. The first thing I want to show you is the CDA USB contact sheet. You may not know this, but I work for the State of Maryland Department of Housing, and our state agency has so many different departments in it. So I'm in the department called CDA, Community Development Administration. And for those of you that have been in the market for years, yeah, you're going to know us as the Maryland Mortgage Program, but we are also known as just CDA, because that's what we've been forever. We just started calling our products the Maryland Mortgage over the last few years. This is a contact sheet. Now, again, I'm standing here in front of you guys as agents, so I will tell you that you really want to reach out to your lender. And as I said, you're in the best hands, Primary Residential on top. Got it every day, all day. So when you do submit a loan to one of your loan officers at Primary, you're going to ask any questions to them. They might even reach out to you as the agent to have you guys work collectively together with the borrower to get documentation or whatever that you need. But there is a CDA contact sheet. And probably for you guys as agents, the only one that you might use is this single family housing .dhcd. DHCD stands for Department of Housing Community Development. That's the head of my agency. But really, we could only answer general questions. If you're really talking about the particular loan that was submitted with us, we're automatically going to refer you to go to the loan officer, because our relationship is with the loan officer, the lender, not. Even if a borrower calls us, we really don't answer questions to a borrower. We refer them directly to the loan officer. The lenders, believe it or not, think of it this way. They are processing and underwriting and originating based off of agency guidelines. So that's, Fannie, Freddie, conventional, FHA, VA, USDA. It's basically, there's 2 guidelines. Agency guidelines, because again, at the end of the day, they've got to make sure they're meeting agency, but when they're doing a Maryland Mortgage Program loan, they're also meeting our compliance guidelines. So if you have any questions, I would really honestly, I would just reach out to the loan officer. But again, you can always reach out to us. This is our email box. It's being monitored and someone will respond to you right away. There's no delay. I'm going to hit the back arrow. I'm going to get back to the list of bullets. And the first thing I'm going to show you is the interest rates, because that's what everybody wants to know about. This rate sheet, if you sign up in that yellow box, the rate sheets are generated every day at 10. And here are the products that we're going to talk about. I'm going to make them bigger. Too big, so it won't fit on the screen. Okay. All right. So here we go. The products are as follows. On the left-hand side of this rate sheet, those are called our first-time advantage products. That is where your borrower has to meet our first-time home buyer guideline. Believe it or not, you do not always have to be a first-time home buyer. So you can be a first-time home buyer and stay on the left-hand side of the rate sheet. But if you're not a first-time home buyer, you don't have to be anymore. You would just stay on the right-hand side of the rate sheet. Well, how do you determine if somebody is a first-time home buyer? With any product you do on my rate sheet, I will tell you that this is required to be your primary residence. You can never rent it out. If you have a client that comes to you as an agent and say, oh, I love the house that you sold us, but our family's growing and we need to move up, but we'd like to keep this townhouse and rent it out. Well, if you want to keep any loan product you have with us to use as an investment property, you have to pay us off in full. There cannot be any liens with any Maryland Mortgage Program loan associated at all. It always has to be your primary residence. The other thing is we don't allow you to own anything anywhere in the world at the time of this closing, even your spouse. So let's say, I kind of use the word Debbie always shared with me, spouse, no house. Let's say, two people are getting married and now they're married, but this young lady owned a home, but they're keeping it. Nope. If you're married, no. If you're single, well, maybe we wouldn't figure that out. But if you're married, no one can be on a deed or have any interest in any property anywhere in the world at the time of this closing if you're on our loan or on our title. Because you could have a borrower that maybe isn't on the loan, but they want to be on title. And the reason why we say you can't own anything anywhere in the world at the time of this closing is so that we're pretty sure you can't get a loan with us, use this as an investment property, and then go move in your other house and live there. You can't own anything. But, I live in Owings Mills. So let's say I came to you and I said, this pandemic has made me cuckoo for Cocoa Puffs. I want to move near the water. If I'm going to sit in my house and telework all day, I want to be able to look out the window and look at the water. So you'd say, Catherine, you know what? I can still do a loan with you through the Maryland Mortgage Program with the lender. You don't have to be a first-time home buyer. You just have to sell your current home. Okay, that's fine. Sell my house. I could still do the Maryland Mortgage Program loan. Now you have to figure out what side of the rate sheet you're on. The lender is going to help you with that. The first eligibility guideline, which is the cheat sheet Melissa sent out, says in order to be considered a first-time home buyer with the Maryland Mortgage Program, you have to meet one of the following. A, never own a home anywhere in the world at the time of this closing. B, haven't been on a deed anywhere in the world at the time of this closing in the last 3 years. C, believe it or not, a veteran. If you're a veteran using your VA exemption with us for the first time, we will consider you to be a first-time home buyer. And D is if you are not a first-time home buyer at all, but you said, listen, this house that I'm buying, the lender pulls it up on this thing we have called a mapper, and it says the property is in a targeted area, which targeted areas are generally where the state of Maryland Department of Housing and the state of Maryland Department of Planning have zoned to be targeted and what are targeted. Baltimore City's all targeted. Why? They want people to move into the city. So if you're talking to anybody and they want to buy in the city, they're hands down a first-time home buyer with us. They can't own anything, but they're automatically a first-time home buyer. But even think of I grew up in Montgomery County, supposedly the richest county in the state, right? Well, in Montgomery County, of course, Potomac is not considered to be targeted, but there's parts of Silver Spring, Germantown, Gaithersburg, Wheaton, that are zoned for targeted because what is targeted? They want people to move into targeted areas to help revitalize the community. So if you're buying a house with the Maryland Mortgage Program and you're buying a property that shows up on the mapper that the lender will do, and it's in a targeted area, woohoo, you're a first-time home buyer. It's that simple. So you only have to meet one of those guidelines, A, B, C, or D. And the lender will assist you to determine if you are meeting as a first-time home buyer. And the borrower might be like, no, I'm not. But let the lender do their magic and they can see if in any way, shape, or form the borrower is considered a first-time home buyer. The
Can I,
product, yeah,
can I ask a question?
sure.
So what if you're buying a home and you're living on one floor? Would you be eligible to rent out the lower floor, but you're still in the building, in the house?
Okay, so this is kind of a two-parter. Number one, we do not do any Maryland Mortgage Program loans for down payment assistance on any multifamily unit. Okay?
Okay.
Number two is you can never, if you have a Maryland Mortgage Program loan, you can never utilize this property for any type of investment purposes. So that's even renting out a house or a room or anything. It
Okay.
has to, yeah, it has to be the use of your whole entire primary residence. No investment at all.
Thanks. Mhm.
Okay, all right?
From the state's point of view, what's the drawback to providing financing for somebody that maybe was looking to buy a multifamily?
Yeah, I don't, to be perfectly honest, I don't know. I guess the program was designed to help people purchase homes for primary residence, whereas if they didn't use our program, they couldn't have. So do we have a multifamily division? Yes. We have a commercial lending division. We have a neighborhood revitalization division, but I can tell you that none of them offer any down payment and closing cost assistance. But they do have generating loan programs, but not any down payment
Because
assistance.
it's kind of like, you walk into a traditional lender and they automatically want 35% down. It's kind of like game over,
Yeah.
for a lot of people.
Yeah.
And
Yeah.
anything multifamily obviously is considered commercial, and now you're in a whole different ballgame.
Yeah, so we do have a commercial lending division, but the Maryland Mortgage Program does not participate in any of that. That would be something where you want to reach out to our general website, which is www.dhcd, D as in department, H as in housing, C as in community, D as in development, at Maryland, MARYLAND.gov. Because we have so many different departments within our agency. I'll even kind of sidebar and tell you that our agency has also been given a crazy amount of money from the federal government to offer, it's called the Rental Assistance Program. And then we also have a Homeowners Assistance Fund, it's called HAF, where because people were adversely affected by the pandemic, we don't want people to be displaced from their housing. So the federal government gave our agency rental assistance money and housing assistance money for a mortgage. So if you've been adversely affected and you're, maybe in default or possibly going to be evicted, reach out to our state agency and ask about those, because that's money that is set aside, but that's not with the Maryland Mortgage Program. There's so many different departments within our agency. Okay, so in order to be considered a first-time home buyer, we went through A, B, C, or D. You, as an agent, would rely on your lender to help you figure out if they are a first-time home buyer. But on the right-hand side of the rate sheet, these are called our flex products, and you don't have to be a first-time home buyer. So the rates are a little bit higher on the right-hand side. There's not as many products on the right-hand side, but it's available to you, okay? Now, when you're doing these programs, I'll briefly explain them to you. Whoops, I just did that a little too fast. I'm used to having my mouse. The second eligibility guideline that we have before I explain the products is income limits. So when you're talking to your clients, you're of course asking, who's going to live in the home? You're trying to determine the size of the property they're interested in, what needs they're going to need, etc. Right? So you're going to ask, when you turn the loan over to the lender's going to, of course, ask some questions. The lender's going to ask not only for the income verification for the borrowers, like mom and dad, let's just say typically, but they're also going to ask about who's going to be living in the home. Because with the Maryland Mortgage Program, we have household income limits for anyone on the loan, on title, or living in the home that's 18 years or older. We don't allow any co-signers. So if you're on the loan or on the title, you got to be living in the home. And if you had, let's say you were caring for your elderly family member, grandma, Okay, well, we need grandma social security, or somebody that's collecting SSI, we need SSI income verification. Let's say you have a child that didn't go to college and they work at Home Depot full-time. Well, Johnny, you're just gonna live in the house, we need Johnny's income verification for Home Depot. So that's different. The lender uses the income based off qualifying, and we at the Maryland Mortgage Program use household. And I'll show you the income limit chart, just so you can see. The income limits are extremely generous. And again, the lender will help you with this as well. But scroll down. Here's the income and purchase price limits. This chart is always updated. You'll notice, like for instance, let's use Anne Arundel County. If you have 1 to 2 people in the household, if the property is in a non-targeted area, you're capped at 106. But if the property is in a targeted area, they even allow you to bring more money in the door. Why? Because they want you to move into a targeted area, right? If you have 3 or more people in Anne Arundel County, for a non-targeted property, the maximum household income limit is 121.9. If it's in a targeted, it's 148.4. If you come down here and you look and see, you're looking at Frederick County, woo, look at them income limits. Woo, they're high. And notice too, they don't differ whether it's targeted or non-targeted. Also for Prince George's County and Montgomery County, those income limits are very high as well. So not only is this product not for just a first-time home buyer, but it's not for low to moderate income either. So before I came in here, I was on the phone with a brand new LO, and he was like, oh my God, look at these income limits. It's not for low or moderate. So you could be talking to a friend or a family or a client, and they are like, oh, I make too much money. Well, maybe you do, but let's revisit and see, because these income limits are extremely generous. Again, it's household, but they're very generous. So the lender will help you determine to make sure that the borrower is not exceeding our household income limits. The third eligibility guideline is assets. On the cheat sheet that Melissa sent out, the asset guidelines are that you cannot have more than 20% of the sales price of liquid assets. So we count liquid as being checking, savings, CD, stocks, bonds, mutual funds, a gift of equity, and also proceeds from the sale of the home. Okay, we don't count anything in 401 or retirement, so you could have a boatload of money in there. We only count liquid. You cannot have more than 20% of the sales price of liquid assets. The fourth eligibility guideline is we have home buyer education. All the borrowers have to take home buyer education. So I just clicked on the home buyer education link. It will tell you here that home buyer education can be any class approved by HUD, Fannie, Freddie, as long as it meets the master insurer. It also will let you see that you could take it through a local housing counseling agency, either through HUD or national industry standards, that's the NIS. We don't regulate any of these counseling agencies. They could be free, they could charge you, they could, some of them I've heard will have you come back and do like a one-on-one counseling for budget. We just look to make sure that the borrowers have completed their home buyer education, they got a certificate, their names are on it, the certificates are valid for 1 year. But even before the pandemic, but during the pandemic, obviously it was very, very useful to be able to do it online. So your borrowers could do it online, their pajamas with a cup of coffee. You've got Arch, you've got Homeview, Hope, Essent. It's very convenient, especially too, if you think about it, if you have somebody, like let's say they live in Jersey and they decided they want to move back to Maryland. Well, what are they going to drive all the way here to take a class? No. So you've always been able to do online classes. It's just a matter of, it was really people really took advantage of it during the pandemic. And a lot of people still do now. I know that Homeview is free, but some of the others might charge. Again, we just look to see that the borrower took the home buyer education. The lender is going to submit a file to us. It's going to have a copy of the certificate. We look to make sure any borrowers are on that certificate and that the certificate has not expired. It's only valid for 1 year. We don't need grandma to take the class or Johnny, no household, just the borrowers. Okay. We're rolling right along. As you can see, I could probably do this in my sleep.
Yep. You sure
I do
can.
it all the time. But the next one is our DTI. Our debt to income ratio is at a 45. The lenders will pull the credit. The lenders determine what the debt to income ratio is. Believe it or not, they do not send us the credit report. We are not processing or underwriting this loan. We just look at the first page of the credit report just to make sure that you have not exceeded or that you've met our eligibility guideline. So we look at the one page of the credit report to make sure it's the credit score is at, our DTI is calculated, and the sixth and the final eligibility guideline, I kind of just already gave it away, is the credit score, 640. So we don't do anything below 640. There was a time where we did a 620, but those days are gone. 640 is the least credit score we'll do. So as an agent, even though you're really relying on the expertise of primary residential, you are basically being able to kind of say, hey, are you a first-time home buyer or not? Let me see. Let me look at your income. Let me look at your assets. Your home, just I want to let you know, you got to take home buyer education, DTI credit score. And as long as you as the agent feel that you're talking to a client that you think pretty much meets the 6 guidelines, it makes a better working relationship with you as the agent and the lender to say, hey, you're the expert on this. I'm the expert at what I do as an agent, but I think I got somebody who's going to fit. Now, again, we all know there's surprises because borrowers don't always tell you everything, and then you find stuff, but at least it makes it an equal playing field. Yeah, good.
It's 45, but you can go to 50,
Yeah.
on certain loans, but that's in the product matrix.
Yes.
It's all there.
Yeah.
And the other thing is, if someone's close to that 640, if we get them ahead of time,
Yeah, help
we
them.
can help change the credit score, right, up the credit score, but you have to do it before they go under contract,
Yeah.
right? Other situations, we can do it while in process, but not MMP. You have to have the credit to 640.
Work all your magic before you
before.
submit it to
Yeah,
us.
So,
Yeah.
so don't disregard somebody that has a 630. Let a lender look at it. Well, let us. Let's just
Right.
be
Yeah.
let's face it.
I guess the key is to get them comfortable enough to work with you all.
Right.
And then just,
Yeah.
Yeah.
Usually.
And not to sound silly, again, because I swear I still have sales tattooed on me. I think it's great when you as an agent have a working relationship with a lender, you guys can do like home buyer workshops
Mhm.
together. And that way it helps you as the agent so that your borrowers are comfortable with that lender. And again, not to even be silly, but before this pandemic, I would be in a room, like when I first came to the agency, I did all homeowners, but I haven't done that, God, in 10 years now.
Mhm.
But I kind of wiggle away and wiggle my way in. My boss is like, Catherine, were there borrowers there? I'm like, yeah, but it was a lender or an agent event. But if you wanted to do a lender training to introduce your lender and you're the agent, you could always bring one of your prospective clients. And then that way they can see how well you guys work together. You're being very transparent. I could do a presentation and they could have a better understanding of what programs are available to them too. Because like you mentioned, Kathleen, a lot of borrowers don't have a clue as to what programs are out there. Even some of my friends, they're like, listen, I don't want to know your personal information. I'm just going to hook you up with a lender. But there's so much money that is available to borrowers and they don't think that they can buy a home because they don't know what's available to them. And I'm like, yeah, you're missing the boat. There's a lot of programs out there. So you guys could do events and you could always certainly invite me. And if it's a lender or an agent, it doesn't matter to me who else is in the audience,
That's good.
Yeah. And as Kathleen mentioned, here's the product matrix.
I guess the only thing is like how, it's like, doesn't like state law prevent agents from like direct referring or steering a client? So I guess the thing is just to get them to
Steering.
talk to you on their own, right?
Yeah. Well, the theory is technically you can, suggest. You're not steering. You're saying, here's someone that you can talk to who's well versed in the programs. A lot of people think it's that to get 3 lenders. That actually is not true. But there's nothing wrong with that referring someone to a trusted partner.
Mhm.
Just like we can refer our buyers that might not be agent related to agents that we know might work in certain areas to help those buyers.
Yeah, that was always my concern, like, how you walk that fine line between, if you find a lender that you trust and know will do good things, how do you, recommend them without recommending them? Saying like, how you.
Well, I would just say that this lender is particularly well versed in the programs that I think you would benefit from. And you're not saying you have to work with that lender. You're just saying, have a conversation, see if it works.
Yep. And I'll be honest, I work for the state of Maryland. I have 120 lenders. Some of my other lenders are in this office, but they didn't invite me. So,
We're glad they didn't.
So again, it could be, you have the option of introducing them to any lenders.
Sure.
But, you can always say, well, I've worked with this lender a couple times, I certainly can pass on the information. Or if you're having an event here, you can always invite a client and then, they can pick who they want to use. But at least you're, showing them fair presentation.
Sure.
Yeah. So what Kathleen also brought up too is, yes, the DTI is at a 45, the credit score is a 640. But right here, like for the products I'm going to go over with you in a second, credit score standard 640, but on any conventional product and any FHA product, we will allow you to go up to 50% DTI, but the credit score has to be at 680 or higher. But the core standard is at a 45 with a 640. Okay. So we literally just went over the 6 eligibility guidelines. I showed you the income limit chart. The lender's going to do the mapper. We went over assets, homebuyer education, DTI, credit score. Now we're going to look at the rate sheet. And I'm basically just going to go over the different products with you. So you can kind of see what is a good option for your borrower. If you are in fact our first time home buyer, you would be on the left-hand side of the rate sheet. And the products on the left-hand side, if you notice, the rates are a little bit lower on the left-hand side. I'm being very transparent. There is 4 more pieces of paper that are Maryland Mortgage Program papers. It's a form called the buyer's affidavit. There's a seller's affidavit, and there's a notice to a borrower. And then we do ask the lender, where have they been for the last 3 years? Are they really a first-time home buyer? You got to either show me the mapper or show me 3-year tax return so I know where they've been the last 3 years. So there is a little bit more work to do on the left-hand side because they're benefiting by a lower rate. But like I said, the forms are very easy to fill out, and it's just having the borrower tell us like who's going to live in the home, so we know if grandma's going to live there. Because people always say, well, how do you know who's going to live in the home? Well, there's a form on the government. There's a form that they have to fill out. It's called a buyer's affidavit. It tells me who's on the loan, and then you tell me who's going to live in the home and how old they are and what their relationship is to you. So you're basically, as a borrower, telling me who's going to be on the loan, who's going to be living in the home, so that the lender knows who to ask for income verification from. The products on the right-hand side, currently right now, there's only 3 products. They are called our flex products. The products on the right-hand side allow you the flexibility of not being a first-time home buyer. The rates are a little bit higher, but I will tell you, the programs are very simplified. It's a skinnier packet because we don't care where you've been the last 3 years. We don't ask you who's going to live in your house. It's very simplified because we're not doing that first-time home buyer question. The first-time Advantage Direct and the Flex Direct, depending on what side of the rate sheet you're on, is the lowest rate on our rate sheet. The reason why is because the lender may have said, like this government rate, 4.750, might be the lowest rate that they can give. Maybe it's lower than what they even offer in your house. So the lender's going to say, listen, I can't even give you this rate, but the state of Maryland has a program called the Maryland Mortgage Program. And if you meet these 6 eligibility guidelines, you can do the first-time Advantage Direct or the Flex Direct. You're not getting any money from the state. There's no down payment assistance because you don't need it, right? But I'm going to offer this product to you because it's the lowest rate I can possibly find out there, including in my own house. The other advantage as to why, because some agents might be like, well, why on earth would they use your product if they're not getting any money? When you do a Maryland Mortgage Program loan, we are a state agency, but we are also known as a housing finance agency. And Fannie Mae and Freddie Mac said and there's a directive that was sent out, that if your borrower's qualifying income, not our household, but our qualifying, I'll even be transparent enough to show you the directive. If your borrower's qualifying income comes in below their 80% AMI, their area median income, with us, we'll give you a discount on your mortgage insurance. So instead of you having mortgage insurance at the standard of 30 or 35%, we'll give you a discount on your mortgage insurance at 18%. So this is the directive that was sent out, and this has been going on since 2021. If you're talking to a borrower and you know that the borrower's qualifying income is coming in at this 80% or below, then you might definitely want to use the Maryland Mortgage Program, whether you're getting down payment assistance from us or not, because your lender could give them a discount on their mortgage insurance. It'll drop from the standard of 30 or 35% down to 18%. That's huge. Okay.
Significant.
So that's why some people end up using that First Time Advantage Direct program with us, even though they're not getting any money.
And also, when you buy it out, it makes it so much more
Oh,
attractive.
yeah.
And they can qualify for more, which is, it's a great program.
Yeah, because any money that it has to be a borrower paid, it can't be a lender paid. But if they have money to do a single premium and pay out their MI, woohoo, great, it's only on a conventional. But even with these other programs that I'm going to talk about right now, if you're getting any down payment and closing cost assistance from us, it can be used for down payment and closing costs. Well, mortgage insurance is a closing cost. So if you've got some money left over, instead of getting POC back, which we do allow, or any money that you have extra, you wanted to put it down as a principal reduction, which we allow, why not check out and see if you can take that money that you have left over and use it as a principal reduction? I'm sorry, as a single premium, and pay out your MI up front. Your borrower will have no clue what you did, but they'll love it because their payment is lower and they don't have any mortgage insurance. Okay. So
Quick
now,
question,
go ahead.
So like going three years in the future, would any of these loans be assumable?
No.
No, even if they meet the minimum requirements, they can't assume.
Yeah, no. So all of the Maryland Mortgage Program loans, these are the rates for the first mortgage. There is no interest rate for any down payment assistance. It is recorded as a second lien, but it's kind of like a silent. So there's no rate, there's no payment, no monthly payment requirements. It just kind of sits there on the title as a silent lien. And when you sell or refi, it has to be paid back. We don't ever forgive it. It doesn't magically go away after a certain amount of years. You owe the state of Maryland money, you got to pay them back, right? The First Time Advantage 5,000 and the Flex 5,000 and the First Time Advantage 3% loan and the Flex 3% loan, I like to lump them together because if you looked at the First Time Advantage 5,000, look at the rate, and then you looked at the First Time Advantage 3% loan and look at the rate, they're exactly the same. That's not a typo. And if you look at the Flex 5,000 and the Flex 3% loan, depending on what side of the rate sheet you fall on, those rates are the same. So I like to lump them together when I'm talking about them. These are the rates for the first mortgage. As you notice, there's conventional Fannie and Freddie, and the government rate is FHA, VA, and USDA. And your borrower would get a down payment assistance that's recorded as a second lien. No interest rate on the second lien, no payments on the second lien, but you got to pay it back when you sell or refi, and you get $5,000. Okay. Well, that $5,000 product used to be the only product that we had, and I think it's been around since before I was even conceived. It's been around forever, I swear, like good old CDA, right?
Yeah.
So we're not ever going to get rid of that good old boy $5,000, but this 3%, it's 3% of the total first mortgage, round down, no change. So I don't know about you, but I'm all about getting the bang for the buck for my borrower, right? If I'm going to have to meet the same eligibility guidelines, depending on what side of the rate sheet I'm on, I have the same exact interest rate. Do I want to give my borrower $5,000? Or if 3% of the total first mortgage, round down, no change, is more than $5,000, give them more money. It's the same rate, right? Just give them more money. And then, if If we're a 97% LTV at a fixed 30, you're getting 3%. Okay, it's not a math problem. I mean, it's not that hard to figure out. You just literally made yourself 100%, right? Now, we just started rolling out these new programs. As Kathleen mentioned, we did have products that were called grants, where we were giving you money for down payment and closing cost assistance, and you didn't ever have to pay it back. Well, with the market the way it was performing, those rates were going up and up, like 7-8%. So we weren't seeing a lot of utilization from the lenders, and I understand why. So I literally talked to the lenders. I talked to Dean, you know, their chief, other top performing lenders, and you know, I'm a business development rep. So if my state says we want more business, I go to them and say, what do you want me to do? What do I need to do? Well, Catherine, we need your rates lower. Okay, I know that. I'm trying to work on that. But what else do you need? Well, how about you take the grants that you had over here, and we're not going to use them anymore. We don't want the grants, but turn them into down payment assistance that's recorded as a second lien. So the rate will be lower, but it's still going to give them money. So we had a 3% grant and a 4% grant. Well, I said, let's just get rid of the 3% because we have the 3%, right? But how about give me a 4 and a 5? Well, believe me, I had to like wear knee pads and walk around the office in my knee pads for days because I sold them on the 4%, but they were like 5%. I mean, you guys, I work for the government.
Right.
So I'm dealing with finance gurus and number people.
Yeah.
So I had to break it down. 3% of the total first mortgage round down, no change. There's the rate, they got to pay the money back, right? 4% of the total first mortgage round down, no change. All right, bump the rate up a little higher. They still got to pay the money back when they sell or refi. 5%, you guys aren't getting any seller help.
Right.
So I had to go to them and say, do you understand that there's no seller help? So these people have no money. They've got good credit. They've demonstrated the ability to pay their rent on time or whatever, but they don't have any money saved. So if we gave them 5%, you could use 3% towards down payment and the other 2% towards closing costs. Wow. There you go. There you go. So I will tell you, now I'm trying to get them to take, it used to be that our left side of the rate sheet mirrored the right side. They were the same products. Just, are you a first-time home buyer or not? And if you're not, you pay a higher rate. Well, so I got to work baby steps with them. So I only have these products on the left. I'm trying to get them, we only just launched these a month ago. So I would think by the fourth quarter, if I see a lot of performance out of the 4 and the 5%, I can say, all right, finance gurus, can you also give me the 4 and 5% for somebody who's not a first-time home buyer? I know the rate's going to be a little bit higher, but I think that it will perform in the market.
And it's kudos to that, you know, increase, because I had a buyer, initially we started with a 3%.
Right.
And then they were a little short, and I said, you know what? For an 8% more, I can get you it was a $300,000 loan.
Yeah.
$3,000.
Yeah.
You know, it will really help you. And so we changed it to the 4% loan.
Yeah.
And we're so happy.
Yeah.
So
Yeah.
yeah, it was great.
It is. Yeah. So I'm hoping that, you know, that we see a lot of activity from it. And then we can also have the same products on the left-hand side that are on the right-hand side. And then it'll be a lot easier for me to do training too. They're like, yeah, that's what you want, Catherine, but yeah. All right, so the last product, I'm not even really going to talk about the conventional refi. I mean, are you kidding?
It's
Look at that rate. Joking.
It's over. It's over.
We created this conventional refi program literally back in 2009 when the foreclosure crisis was horrible and everybody was underwater. So if we had that good old boy $5,000 product and you found that it was a benefit to you to refinance out of it because there was a better rate in the market, you had to pay that $5,000 back. Well, if you were underwater, you couldn't. So we created the conventional refi. So if you refinance any product with us now, out of us into that conventional refi, we will allow you to subordinate the lien. So I'm sure there's still somebody that's probably using it because they're desperate. I don't know. I shouldn't say that. I hope my boss doesn't hear this, but I just, okay. The Smartbuy, woo! Have you all heard of Smartbuy?
Best program ever.
All right, what's your name in the back?
Marshall.
Hi, Marshall. Have you heard of Smartbuy? No? Okay. Any of you on the screen? Anybody in the Zoom land? Because I'm telling you, this product is literally winner chicken dinner. Winner chicken dinner.
Does this have anything to do with the student loan?
Yes.
Yes.
Oh, it does?
Yeah. Okay.
John mentioned that.
Okay. And I'm so sorry I didn't ask your name.
George.
George. Okay. So if I were a loan officer again, which in 3 years when I turn 62, I will come to work with you guys.
Oh,
But I already told Dean, but I plan on retiring in 3 years and then I want to go work as a lender. But I'm telling you, if you ever talk to a borrower and they need down payment and closing cost assistance, and they are meeting our first time home buyer income, assets, DTI credit score, home buyer education, when you pull their credit or you talk to them and they say, oh yeah, I got student loan debt like out the wazoo, right? Then say, all right, loan officer, I got a borrower that needs down payment assistance and I think that they're going to be eligible. The Maryland Smartbuy is a fixed 30, but it's a 95% conventional. The others are 97. It's only conventional Fannie and Freddie. You can still take advantage of the discount on the mortgage insurance, like I told you, if you reach that AMI. But if you're talking to a borrower and they have student loan debt, they have to have at least $1,000 of student loan debt. So let's say you have a husband and wife, John and Cynthia. You asked John, John said, all of my Sally Mae, Great Lakes and everything is $29,000. And then his wife, Cynthia, has like $70,000 of student loan debt. The Maryland Smartbuy, you have to be a first-time home buyer. The credit score is 720 or higher. It's only conventional Fannie and Freddie. And you have to have at least $1,000 worth of student loan debt. The first mortgage is a 95% conventional. So the borrower's got to have a little skin in the game, right? If they need down payment assistance, it's optional. They don't have to take it if they don't want it. And then you're looking at a true 95% conventional. But if they want it, now you've got a second recorded lien for $5,000 that they got to pay back when they sell a refi. With the Maryland Smartbuy 3.0, they can buy any house in the state of Maryland, meet our eligibility guidelines, and you pick one person, either John or Cynthia, and we will pay off a portion of their student loan debt. 15% of the total purchase price up to a maximum of $30,000, whichever is less. Okay.
When did that change? It used to be 30, it had to be paid off for one borrower completely.
Yeah.
So now,
Okay, so let me finish.
Okay.
So you got two borrowers. You got John, who's got 29,000, Cynthia's got 70.
Right.
You tell me whoever you want to benefit from it. You pick one person.
let's just say I say Cynthia.
Okay, so if we pick John, we're gonna pay off 15% of the purchase price to the max of 30,000. Woo! All his debt's paid off.
Right.
Gone. He's got to stay in this product for 5 years. This is the only product we have that has a 5-year rule. If John and Cynthia stay in this product for 5 years and we paid off John's debt, poof, it's forgiven. Governor Hogan said, we just paid off your student loan debt. Okay. If you leave or refinance out of the product within 5 years, then you have to pay us back 20%. It's deferred 20% over 5 years, which still isn't a bad deal. Now, let's say you're like, no, John has got his student loan debt under control. But Cynthia, she's got $70,000 worth of student loan debt. We would love to be able to take a big chunk of that and have the state pay that off. Okay, we will. So we're going to pick Cynthia. We're going to pay off 15% of the purchase price into the max of 30,000, whichever's less. And that's not going to pay all of Cynthia's student loan debt off. So Cynthia has to come with some money, because the deal
She's
is
gotta pay off the rest.
whoever you pick, when they walk away from the closing table, they can't have any student loan debt remaining. So if we're only paying off 15% of the purchase price to the max of 30,000, whichever's less, Cynthia's going to have student loan debt left. Now, not to sound silly, we don't care how she pays it off. She could get a gift. She could go and take money out of a 401. She could go get a personal loan, and then you'd have to count that personal loan monthly payment of your DTI. But like Kathleen mentioned, what's really cool is if you're paying off somebody's student loan debt, you're not having to count that in the DTI. So it's giving the borrower more purchasing power. It's huge. This is a Governor Larry Hogan initiative. The Maryland Smart, and I'll even say this too, and not that I'm totally showing favoritism, but Governor Hogan rolled out this Maryland Smartbuy 1.0 in 2014. And that was only restricted, it was restricted. You could only use properties that were in foreclosure. Okay. The Maryland Smartbuy 2.0 came out, and then you could use any property you wanted to, and they actually paid off more. They paid off up to 40%. Yeah.
Wow.
Yep. The Maryland Smartbuy 3.0, you can buy any property, meet the qualifications, and it only pays off up to the 30. Primary residential was the very first lender to do the Maryland Smartbuy 1.0. So it was in Harford County, and the Lieutenant Governor was there, Governor Hogan was there, the borrowers were there. It was really cute. There was cameras and everything, and they bought their first townhome together. They had just gotten engaged. So it was kind of cool. It paid off the young lady's student loan debt. But the Maryland Smartbuy is a Governor Hogan initiative. So unfortunately, Governor Hogan's term is coming to an end.
Are you worried?
I don't know what's going to happen. Because, think about it. If you stay in the product for 5 years, it's paid off. So that means the state is paying off that student loan debt. So I don't know if the new administration is going to still think that this Maryland Smartbuy is a great product. I hope they do. I mean, we've got backing from Fannie and Freddie, so I'm hoping that they think it's a great product.
What was Kelly plan on keeping this going? She went. Because when John
We
first
hope, we
mentioned
hope.
it, it's kind of like, Hogan hasn't done enough to promote this credit because, not just this, but the Smartbuy all together, those people don't exist unless you come across a sophisticated lender that, would know to even into it. So.
Yeah, when it first was created, there was a lot of marketing, a lot of publicity from the governor's office. So in defense, I will share that. But then I guess after that, he kind of left it up to our state agency and as well as the lenders. So it really is all about, my dad always told me, Catherine Kraemer, you need to have a best friend everywhere. You need to network, you need to talk, because that's how you find out about different programs. So I'm hoping that it'll stay. I really do. I think that our agency is going to demonstrate the fact that it really has been a very, very well-deserved and very well-utilized product.
Do you know how many?
I would be lying if I told you I don't. That's something my management does. But yeah, they pull reports every day to say, actually I do get a report, but I don't get the end of the year, but they pull a report every day that tells me how many reservations, how many loans are coming in and what category they fall in. And we always have 1 or 2 Smartbuys.
Okay.
It's not going to fit everybody, but if your borrower's got a credit score of 720, at least see if that's something, if they've got student loan debt, if they qualify.
Now, after 5 years, though, would they be able to refinance if they wanted to lower the interest rate?
Yeah. So you have the option of staying in for 5 years and then poof, it's paid off, forgiven. Or if you wanted to refinance before the 5 years, you would just have to pay 20% back each year. Or if you stayed in it for the 5 years and you're like, okay, good, now it's paid off, now let me refi. Yeah, you can refinance out of any of our programs at any designated time. You are not required to stay in any of them. The only product that has a 5-year rule is because of the student loan portion, but you can still refinance out of it. It's just that you're then penalizing yourself because you don't have your student loan debt paid off. So I would try to sit tight for 5 years.
5 years, right.
Yeah.
Okay,
Yeah.
that's good.
Yeah. So basically, it's now 1:13, and I'm a girl, so I could talk forever, and I don't want to monopolize your time any longer. But we definitely thank the fact that Keller Williams' office brought us here, that the lender Primary Residential brought us here. I wish there were more people here in front of me as well as on camera, but we will do trainings. I don't even want to call it training. It's just we're sitting here jibber jabbering, talking about different products. It's a great opportunity to network. Like I said, if you ever want to do an event where you've invited any of your clients, it's a great opportunity to, bring your lenders collectively together and educate your borrowers. From a lender standpoint, I will tell you, when you originate, when you do a Maryland Mortgage Program loan and you pass it on to the lender, again, this lender sitting here in front of me, we have a lot of gold, silver, and bronze lenders. So there was a lot of lenders. Probably another 100 of them are just our normal performing lenders. But if you deal with a gold or silver or bronze, you'll be very confident in the fact that they're gonna know how to do this. They know that they can reach out to me or my co-partner at any time. We've got, you know, my supervisor of underwriting just called me. I talk to her all the time. You know, they'll reach out to me and let me know if I need to meet with a loan officer or do any trainings to help people. But when a loan officer does originate a loan with us, the lender is processing and underwriting the loans to make sure they're meeting agency guidelines, but then also our guidelines. When they submit a packet to us, that's where they lock in the rate. And when they submit it to us, it only takes us 24, I'm not lying, 24 to 48 hours to review the packet. We're not underwriting the loan. Like when I first came here and I needed to prove that I knew how to underwrite, I was like, this is not underwriting. Like, where's my credit report? Where are my tax returns? Like this was like, check, 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 check. And literally we ask for like the home buyer education certificate. For asset verification, we ask for a VOD or 1 month of a current bank statement for any account you list on your 1003. We ask for verification of employment. You can give me a written verification of employment and you're cool. If you don't have a written, then we need a verbal with 1 month pay stubs to your W-2s. We don't ask for a whole lot of stuff. We really don't. We're not underwriting a loan. We're just saying, do you meet this? Do you meet this? Do you meet this? 1, 2, 3, 4, 5, 6. The lender sitting here in front of me, they do this with their eyes closed. So their loans get turned around very quickly. There's not a lot of issues at all. And quite honestly, it's not, I will say in defense to all my lenders, it's not that the borrowers don't qualify. It's our stupid paperwork. I get it. It's paperwork. You know, everybody's rushing, everybody's trying to get stuff in. So maybe you didn't check a box off or something. But at Primary Residential, they have a phenomenal underwriting staff. So they're checking the checker. They'll be like, you gotta fix that. I'm not signing my name to this. So, and that's really what it's all about, right? You as a lender, as an agent, can easily do a 45-day contract, easily. I will tell you as I'm standing here, this lender can do them in 30. So with this market, when you're talking to somebody and they say, oh, I don't want to do a bond program. Are you kidding me? That's going to take 5 million years. Nope. We've changed a lot. And I'll also tell you too, with the pandemic, you know, a lot of us were driving over an hour to get to work. So I still have to have my normal work hours until like 5:30 or 6 because my lenders never stop. But my underwriters, they start at like 6 in the morning and they're done like at 2:30, 3 o'clock. Even my boss, she's like, okay, bye, call me if you need me, you know, because they're starting work instead of driving there, they're already starting. So the turnaround time has been really, really picked up a lot. You know, we're going to try to work on lowering the rates again to being a little more competitive in the market if we can. We know that you guys are really dealing with a lot of challenges right now, a lot of low inventory, sellers not, you know, contributing. But I think the 3%, 4%, and 5% are definitely the ticket. Definitely the ticket. But I don't know, does anybody have any questions? Is there anything I didn't answer?
Okay.
Any question? Yes.
You said first time treated as first time home buyer, but do you have to sell the current home you're living in order to?
Yes. So anybody you talk to, they cannot be on a deed or have any interest in any property anywhere in the world at the time of this closing. And that's how we make sure that they're going to live in this house.
Gotcha.
Because it's going to be the only house they have any interest in. Okay. Yep.
Timeshares.
Timeshares. Okay. So I'll make you guys laugh. So if I tell you you can't be on a deed anywhere in the world at the time of this closing, cemetery plots, in some instances, are deeds. So we will allow you to have a deed to a cemetery plot because obviously you've never lived there and you don't have the intentions on living there anytime soon.
Live there when you're there.
But Kathleen, thanks for bringing it up. Timeshares. Some timeshares are deeds. So do not ask me where I got this from. I say it to Debbie Connor all the time, like, who made up this rule? You can have a timeshare, but you cannot own more than 2.6 weeks. 0.6.
Okay.
Yeah, so you can't own more than 2.6 weeks of a timeshare with us. So I guess that
And then
maybe
you
the
have to show
length
it
of
to
time
me,
that you'd be in a house, I don't know. Yeah.
I've only had to deal with that
Yeah.
once.
And listen, I'm gonna tell you, I work for the state, but a lot of people that I work with now are from the private sector. So we're not just in this little box. Like Kathleen mentioned, if you have a borrower that has more than, like if your credit score isn't at 640, don't give up, reach out, they'll work with them. Even if you have a borrower that has more than 20% of the sales price of liquid assets, don't kill the deal, have the conversation with the lender. There's some cases where we'll be like, okay, well, but after closing, right? They're gonna have paid all this stuff off, or then you would have used some money towards principal reduction or whatever. So, the program was designed years ago for somebody that was low income, that was only a first-time home buyer, and the state wanted to provide you options to help you buy and achieve the American dream of owning a home. Well, this product we're offering all these different programs, and now we're offering products that you don't have to be a first-time home buyer, and it's not for low to moderate income. You could make 6 figures and still come to the state and get assistance. And then in closing, again, you guys talk to clients or friends and family. If you know anybody who's been adversely affected with their rental or their mortgage payment, please, if we don't spend this money, we're gonna have to give it back, and we don't like to give money back. So this is a 5-year program. They hired a bunch of people contractually to work under these programs to help. So please take advantage. Melissa, were there any questions? You want to look in chat or?
I don't see any questions. I was mostly putting in the files that you were showing. So most of those chats are me.
Okay. That's it. Sorry. Yeah.
Thank you.
You're welcome. You're welcome very much. Thank you for your business. We appreciate you.